Hi, welcome to Chapter 7. My name is Sherry Bergeron, and this chapter is all about inventory. So when we talk about inventory, we're talking about what we have been studying, like merchandise inventory. So we know that merchandise inventory is an asset, and we buy it with the intent to resell it at a profit. So we want to talk a bit about control of inventory. So when we talk about internal controls of a business, we're talking about how to safeguard our assets, as well as how to make sure things are recorded properly and how to make sure that we go by all the rules. But right now, the internal control that we're going to talk about is how to safeguard our inventory. So first of all, we want to keep it safe from damage or theft. And we also want to make sure that we report it properly on the financial statements. We want to report it at the correct value. So when we talk about safeguarding our assets or safeguarding our inventory, one thing that we can do that will help is to use purchase orders. This authorizes the purchase of the inventory from an approved vendor. So it makes sure that we only buy what we plan on buying and what's been approved, and that we use approved vendors. Then we can use a receiving report, which is going to show the initial record of the receipt of the inventory. The price, quantity, and description of the item of the purchase order and the receiving report are then compared to the vendor's invoice before the inventory is recorded in the accounting records. All right, remember that we have two types of inventory systems. We have perpetual and periodic. And we learned that perpetual is the one that is going to best safeguard our assets because it's going to always show what we have and what we've sold, so we know how much we should have. So this is considered an effective means of control. The amount of inventory is always available in the subsidiary inventory ledger. When we say subsidiary inventory ledger, what we mean is that we have a general ledger with all of our accounts, and the overall account is called inventory. But underneath inventory, we would have it broken down by types of inventory. So you might have inventory dash blue jeans, certain brand, inventory dash handbags, inventory. Anyway, you break it down however you'd like, and those are called subsidiary ledger accounts. All right, so controls for safeguarding inventory should also include security measures. So you can either have cameras or you can have those tags, and if they're not taken off, then they will make something, an alarm go off when somebody walks through the door with them. You can use locks, like for example on high dollar electronics, they'll be on a rack, but somebody has to come and unlock it when the customer wants one. So all of these are safeguards for inventory to help prevent customer and employee theft. All right, so some more examples would be storing inventories that are restricted to only authorized employees. So if you have extra inventory, it can be where only certain people can go. Locking high-priced inventory into cabinets, using two-way mirrors, cameras, security tags, and using security guards. No matter which method of inventory used, periodic or perpetual, there always needs to be a physical inventory. That just means somebody needs to actually physically count the inventory, and it's usually done near the period end or the year end to make sure that the quantity of inventory is what we expect it to be, and it matches the amount that we report on our financial statements. All right, when we're looking at inventory, we've got several different inventory cost flow assumptions. And so a business would choose which one they use, and then they would only use that one. So our choices are FIFO, LIFO, and average cost. So I'm going to first show you what that means, and then we'll learn how to account for each one. So just take a look at this example first. Assume that we have 3 identical units of merchandise, and they were all purchased during May. And the one on May 10th cost us $9. The one we purchased on the 18th was $13, and the one on the 24th was $14. So you can see that they were more expensive as we went on. So if you looked at the average cost of those, you would just add up that and then divide by the 3 items, and we would see that we had an average cost of $12. So the question becomes, which one did we sell? So when we're doing inventory valuation flow assumptions, we're going to assume that we do not know which specific item we sold. They were too small, we didn't keep up with exactly the right number. So if we were selling cars, we would know exactly which car we sold because we have a VIN number. But if we're selling identical small items, we don't know which one we sold. So we just assign a cost based on our inventory flow assumptions. Okay, so let's do an example to show. Assume that one unit is sold on May 30th and we sell it for $20. Depending on which unit was sold, the gross profit varies because we got 20, but what was the cost of the good that we sold? So it would depend on which one that we sold. So if we assume that we sold the May 10th one, then the cost of the merchandise sold was $9 and we'd have gross profit of 11, which would leave us with ending inventory of the other two items, so $27. If we assume the middle column that we sold the one that we bought on May 18th, that one cost us $13. That would leave us a gross profit of $7. And what would be in ending inventory would be the other two items, the May 10th and May 24th one, so it'd have $23 in inventory. And if we assume that we sold the last one, May 24th, that one cost us the most, so it makes our gross profit look even lower at $6, but our ending inventory is even higher because, our ending inventory is even lower because the other two cheaper items are what is in ending inventory. So the very first one that we did, we assumed that we sold the oldest item, the one that only cost us $9. That would be FIFO. First in, first out. We assume that we sold our first one. All right, we don't have one that does the middle one. That was just an example. And then if we did the last one, we assume that we sold the last one that we bought. That's LIFO, last in, first out. And as you can tell, this is going to affect our gross profit as well as our ending inventory. All right, there is another option for companies. They can use specific identification. So if they're selling something and they can specifically identify which one they sold, they wouldn't use LIFO or FIFO or average cost. They would use specific identification. An automobile dealer would use this because they have VIN numbers or a unique serial number. And so they're able to specifically identify which one they sold. All right, so here is a picture of our cost flow assumptions. First in, first out says that the cost flow is in the order in which the costs were incurred. So a very natural order. We sell the first one that we bought, first in, first out. Under LIFO, we sold the last one. So we purchased the merchandise and the most recent one that we bought is considered sold. So that's LIFO. And then if we do a weighted average, we get a weighted average of all the ones that we bought, and that is the amount that we use for our cost. So for all of these, the reason that we need to know this is because it tells us our cost of merchandise sold, and it also tells us our ending inventory. All right, so under first in, first out, the first units purchased are assumed to be sold. The ending inventory, therefore, is made up of the most recent purchases, because those are the ones that we haven't sold yet. For last in, first out is the opposite. The last units purchased are assumed to be sold, and therefore the ending inventory is made up of the first purchases, because that's what's left. The weighted average is going to be the cost of the unit sold in ending inventory would be divided by the total so that you have an average, and that is how you would determine your cost of goods sold and your ending inventory. It would just be an average of all of them. Okay, so this goes back to our original example and just shows us once more how it would look and how it would affect our income statement and balance sheet. So we find gross profit on our income statement. So if we did FIFO, that's where we sold the first one. Then we sold the cheapest one. So we sold the one that cost $9 and gross profit is on the income statement. And our inventory would be $27. Notice it's the other two that we haven't sold yet to equal $27. And of course, merchandise inventory is an asset that goes on the balance sheet. All right, and so LIFO means that we sold the last one, so the most expensive one. And so our cost of merchandise sold would be the cost of that most recent one, which would make our gross profit lower. And then on our balance sheet, we would have the cost of the oldest and the middle one because that's the ones that we haven't sold yet. So on the balance sheet, our merchandise inventory would be $22. The weighted average would be an average of all of that. And so the weighted average is $12. And on the balance sheet, it would be a weighted average of the two that were remaining. So that would be $24. All right, take a minute, try this one, and then pause it and look at the answer on the next slide. Okay, so we're going to show this under the perpetual inventory system. And we're going to use this data right here, and I'm going to show you how to put it into a chart. All right, so let's do first in, first out first. So this is our information, and we're going to be using first in, first out. And so we're going to put it into a chart in order to see what our balances are. So the first thing that we were told is that we had a beginning balance of 1,000 units at a unit cost of $20, which equals $20,000. So we got that from right here. We had 1,000 units with a unit cost of 20, and so when we multiply across, we find out that we have 20,000. Okay, so that's line number 1. And then line number 2 is a sale. When we have a sale, we will be putting it into this cost of merchandise sold section because it's a sale. So we're going to be doing the cost of merchandise sold. And so if we're doing FIFO, first in, first out, what we will do is we will sell from the first ones first. Well, we don't have to think too hard here because we only have one level of inventory. Every one that we have from our beginning balance was $20 each. So obviously we're going to sell them that cost us $20 each. All right. Keep in mind that this whole chart is all about our cost. You won't see how much we sold it for here. You will only see our cost. Okay, we're going to account for how much we sold it for, but not on this chart. Okay, so we sold 700 at $20 each, so our total cost was $14,000. And then this will always be our new balance. So we used to have 1,000, we sold 700, so now we have 300 left. They're only at $20. This is our total cost, so this is the amount of ending inventory. All right, let's go to the third line. Here we bought some. So for purchases, that's the part that we're going to be working in. We bought 500 more at a unit cost of $22.40, so they got more expensive on us. For a total cost, we multiply across and get $11,200. Now this is the important part. When we jump over here to get our new balance, we have to keep them separate. So first line is going to be from above, the inventory that we have from above. We already had 300 at $20 for 6,000, that stays. Now we add our new level of inventory. We bought 500 more at $22.40 for this. We have to keep them separate because they cost different amounts. All right, let's go to the next line. Here we sold some more. Looks like we sold a total of 360. Okay, so we're going to sell all that we have from our first level, the $20 level. Sell them all, 300. That didn't get enough, so then we're going to go to our next level and sell the remaining 60. So 300 times 20 is 6,000. 60 times 2240 is this. So all together, we add these two together to get our cost of goods sold for this. And then what's our new inventory? Well, we don't have any at that $20 level because it's all gone. And we still have 500 minus 60, so a total of 440 at this level. Okay, next up, we sell some more. All right, we only have one level to sell from, so we must have sold them from $22.40. Then we have a new balance, 440 minus 240, and so on and so forth. So this chart helps us keep up with our cost of goods sold and our ending inventory, and this is how we do it for FIFO. It's going to be very similar for LIFO. So using the exact same data, we're going to put it into LIFO. So we start with our beginning balance, and then we sold some, had to have sold them at $20 because that's the only ones that we have. Get to our new balance, then we buy some more. Buy 500 at this. We have to break it down. This is the old stuff, this is the new stuff. Now we're ready to sell. This time when we sell it all from the last in. So look right here, which is the last in? The 500 at $22.40. That's our last in, so we're going to sell it from there. We need to sell 360. So we sell all 360 because we have a total of 500, so that's plenty at that level. When we get to this balance, it's important to remember that you keep it in the order that it goes. So this is the oldest, so it's on top, 300 at 20, which we haven't even touched yet as far as selling. And then how many do we have left at the $22.40? Well, 500 minus 360 equals 140. All right, and then you just keep going like that. So I would recommend at this point that you write down your transactions from this slide right here, and then draw yourself out a chart like this and put it in and then check your work. And then draw yourself another chart for LIFO, put it in, and then check your work, okay? Because it can get tricky about putting this in the order of oldest to newest, but then using the newest to oldest. You just want to make sure that you go all the way through it and get to the right answer at the end. That'll be great practice. You can also then use these example exercises as another checkpoint. All right, the last one that we need to do is the weighted average. And so the weighted average is done, it's actually a little bit more simple because what you do is you start off with your beginning, just like we had, 1,000 at 20, and then we sell some. Well, we only have one level, so our average is just 20 because we only have one. So we sold those, and we're left with 300. Now we're going to go buy some more. So we bought 500 at $22.40. When we go to put in the ending inventory, we don't break apart anything. Instead, we average it all together. So to get to this average, you would say 300 times 20 is 6,000. So you can just take 6,000 plus, this times this is 11,200. So 6,000 plus 11,200 divided by the total. So 6,000 plus 11,200 divided by the total, which is 500 plus 300, which is 800. So 800, and you would get $21.50. Each is your average, and then you multiply across, and you'll get 17,200. All right, then when we go to sell it, it's a lot easier to sell under the average cost method because you just sell them all at $21.50 because that's your average. And then you sell some more at the same average. You only get a new average when you buy new ones. So you don't get a new average when you sell them. You just keep using the same $21.50. You only get a new average when you buy some more. So here we would get a new average. We would say 4,300 plus 13,900 divided by our total, which would be 600 plus 200, so 800. And our new average after that purchase is this $22.85. So I would do the same thing. I would look at your example and work that out and practice it. All right, so alongside each of these, LIFO, FIFO, and average cost, we had our journal entries. So I would just take a look at those as well. It's showing you that this is your sales price, and the 14,000 right here is your cost of merchandise sold and how much inventory that you moved out. And that comes straight from this section, the 14,000 here. For this one, it would be 7,740, and for this one, it would be 5,160. So that is showing you your cost of merchandise sold and your merchandise inventory. All right, then I would work this problem, and there's your answer to check your work. Okay, so let's talk about how we're going to report this on the financial statements. Typically, we use cost. That means the original cost for valuing and reporting inventories on our financial statements. However, sometimes we use something other than cost in these situations. So if the cost of replacing the item in inventory is below our recorded cost, then we would use a different amount. And if the inventory cannot be sold at a normal price due to imperfections or style change or spoilage, damage, or obsolescence or other causes, then we would have to do something different as well. So what we would do is we would value it at lower of cost or market. So we'd ask ourselves which one's lower, the original cost that we paid or the new market value. And we would actually record it and report it at the lower of those. So if the market is lower than the purchase cost, then the lower of cost or market method is used. We call this the LCM method. Market, as used in lower of cost or market, is the net realizable value of the merchandise. Net realizable value is calculated like this: the estimated selling price minus the direct cost of disposal. So that's your net realizable value. And direct cost of disposals include selling expenses such as special advertising or sales commissions. So those are costs that we can directly trace to that product, and they're considered direct costs. Okay, so let's look at an example. If we have some damaged merchandise, the original cost was $1,000, the estimated selling price was $800, and the selling expenses was $150. So if we looked at the lower cost or market, then the value of the merchandise is $650. That's the $800 minus the $150. So the net realizable value is the estimated selling price minus the selling expenses. So that's $650. Thus, the merchandise will be valued at the lower of that. So it's $650 is lower than the original cost of $1,000. So we would value it at $650, which is the lower of cost or its market value. All right, so we can apply it in one of three ways. The cost, market price, and any declines could be determined for the following: each item in the inventory, or each major class of category of the inventory, or just the total inventory as a whole. All right, so take a look at this example and then check your work on the next slide. Pause it and work it. Okay, so where does merchandise inventory go? Well, it's an asset, so it gets reported on the balance sheet, and it's a current asset, so it's going to be under the current asset section. And here we can see it on a balance sheet, and it's called merchandise inventory at lower of cost or market, first in, first out. And so it's valued at $120,000 for this company. All right, what if we had errors? Let's look at this. So if we have any errors on our inventory, in other words, we count them wrong, or we incorrectly assign the wrong amount to inventory, or we included the wrong amount for the freight in, any of those things would make us have the wrong amount for inventory, which would affect both our income statement and our balance sheet. So a lot of times inventory errors arise from merchandise that is in transit at year end, because shipping terms determine when the title to merchandise passes. So when goods are purchased or sold FOB shipping point, title passes to the buyer when the goods are shipped. If it's FOB destination, then the title passes to the buyer when the goods are received. All right, sometimes we have errors from consigned inventory. So manufacturers sometimes ship merchandise to retailers and the retailer doesn't own it, they just sell it on consignment. And so the manufacturer, called the consignor, retains the titles until the goods are sold. So such merchandise is said to be shipped on consignment to the retailer, called the consignee. Any unsold merchandise at year end is part of the manufacturer's, that's the consignor's inventory, even though the merchandise is in the hands of the retailer. All right, and so you can just study this chart to see the effect of what happens. If beginning inventory is understated, then cost of merchandise would be understated, and gross profit then would be overstated. And if you've overstated your gross profit, then net income would also be overstated. So just take a look and work through this and make sure that it makes sense to you. All right, the last thing that we're going to cover is a financial statement analysis, which is going to be inventory turnover. So this is a ratio that we can use, and it measures the relationship between the cost of the merchandise sold and the amount of inventory that was carried during the period. So if you put cost of merchandise sold in your numerator and average inventory in your denominator and you divide, you can find out your inventory turnover. And what that's going to tell you is, on average, how many times you turned over your inventory, how many times you sold it. You bought it and sold it. So we can look at this, and to get an average inventory, you take your beginning of the year amount of inventory and your end of the year, you add those and divide by 2, and that's going to give you your average inventory. And then cost of merchandise sold is your numerator. So then you divide it by your average inventory. And for year 2, we got 6.2. That means that we turned it over approximately 6.2 times. In year 1, we actually turned it over a little bit quicker. So 6.41, which is a little bit stronger. All right, and then we can also look at this as days sales in inventory. So this is going to be measuring the same thing, but it's going to tell you about how many days it took you to sell your inventory. So use the average inventory, so that same number that was your denominator now is your numerator, divided by the average daily cost of merchandise sold. So to get this number, all you do is say your cost of merchandise sold divided by 365, and that tells you on average how much your cost of merchandise sold was per day. So when we do that, we can find out that for year 2, it took us on average 58.9 days to sell our inventory. And in year 1, slightly better. We sold it a little bit quicker at 57 days. So as with all ratios, financial statement ratios, it is helpful to compare to the prior year or the prior period, and also compare to other businesses in your same industry. And that's how you can tell if you've got a favorable ratio, or if it's getting stronger, or if it's getting weaker. And so that's how we can use our financial ratios when we compare. All right, so again, just work this example exercise and then check your work on the next slide here, and then let me know if you have any questions. Thank you. Bye.